Hi everyone. Now we will discuss LC bill discounting.
Sir, what is this?
Before we discuss LC bill discounting, we need to have a basic idea of bill discounting first. What is bill discounting? Bill or invoice discounting is a bank product or line of credit in which the seller gets the amount in advance at discounted rates from the bank, that is the lender. The buyer needs to pay interest and or commission to the bank. Let's see an example. Suppose a seller sells good worth $25,000 to a buyer on 30 days credit and raised the bills. Now, seller wants to get money from the bank before 30 days. Banks discount or charge interest rate of $1,000. The bill ownership is then transferred to the bank. Seller now gets $24,000 from the bank before 30 days. The buyer will anyhow deposit $25,000 to the respective bank on the 30th day only. This banking product is termed bill discounting or invoice discounting. Bills that come under bill discounting are termed as bills of exchange. Bill discounting feature can be used to avail loans up to approximately 90% of the raised invoices. The credit period majorly depends on the buyer's creditworthiness. Once the bank is convinced, it provides a discount on the amount that is required to be paid at the end of the credit period. LC bill discounting is a modified version of bill discounting. What is LC bill discounting? In the case of bill discounting, credit risk of funding, the bank is dependent on the creditworthiness of the buyer. In international trade funding, bank is not comfortable with these kind of credit risk as buyer resides in some other country. To mitigate this kind of credit risk, a concept of LC bill discounting has come into force, in which the credit risk has been shifted from buyer, that is the importer, to the LC issuing bank. And creditworthiness of a bank is always far superior to the buyer. So in simple terms, the funding bank is able to play safe without worrying about the default risk of the buyer. In the letter of credit discounting process, the bank purchases the documents or bills of the exporter and makes the payment to him for a security or a fee. Let's take an example of D&D Limited as the buyer and TNC Incorporation as the seller. There is a sales contract done between the buyer and the seller. The seller then sends the shipment to the buyer. The shipment bill is generated. The bill ownership is then transferred to the bank. The bank pays the discounted bill amount to the seller. As we know about the letter of credit, this is an assurance given by the buyer's bank to the seller or exporter that the value of goods purchased by the buyer will be paid in full and on time. If buyer does not do so, the bank will pay the seller. The contract is made between the buyer and the seller. The buyer applies for the LC. The seller then ships the goods. The document is sent to the bank by the seller. The bank does the payment ahead to the seller. We have also learned previously, whenever trade occurs, the seller gives the buyer a credit period of 2 to 3 months. In this time period, the seller has to face a shortage of working capital. To sort out this problem, LC bill discounting is used. Let's say an example, there is an importer from India and an exporter from the USA. The shipment is sent on 1st January. The credit period is set for 2 months. The payment will be made on 1st March. The exporter has to manage working capital finance for this duration. The exporter then applies for the LC bill discounting. To meet the shortage of working capital in this period, the exporter needs money. Under this system, the bill which is to be paid by the buyer to seller is purchased by the bank. The price at which bank purchases the bill is lesser than the actual bill value. Bank may deduct the processing fee and interest on the actual bill value. Bank collects the amount from buyer as stated in the agreement. LC bill discounting process flow. Let's take an example. There is a buyer, D&D Limited, and the seller, TNC Incorporation. The shipment is sent from the seller to the buyer. The seller then submits bill of exchange and other documents to the funding bank. The funding bank sends bill of exchange for acceptance to the buyer's bank. The buyer bank then sends bill of exchange for acceptance. When the bill of exchange is accepted, the buyer's bank sends the accepted bill of exchange to the funding bank. The seller sells the bill of exchange to the bank. After deducting the margin, bank makes the payment. Let's see the process flow of collection of money from the buyer. The funding bank sends bill of exchange for payment. The buyer's bank then sends document of reimbursement. The payment is made by the buyer to the buyer's bank. The buyer's bank then transfers the payment to funding bank.